What's up YouTube, this is The Working Investor, and today we're going to talk about mutual funds and ETFs. So have you ever wondered, what is a mutual fund, what is an ETF, and why, which one is better for this day and age, and then how can you look up a good ETF? So we're going to address all these questions today in this video. So what are mutual funds? So mutual funds are managed funds that are managed through a broker, and they take hefty fees, and they're basically buying and selling stocks and all kinds of other assets on your behalf. But then every time they're buying and selling it, you're going to be absorbing that costs, and then you're also going to be absorbing, they also charge fees as well. So you're absorbing transaction costs, you're absorbing their fees, and you're also absorbing some tax problems. So let's take a look at some, some of the data we see on Forbes.com. This was a little publication. So they Mr. Kim talks about, some of the reasons why mutual funds pretty much suck. So again, so you have the disclosed costs, which there's the hidden costs. Then there are like tax inefficiencies. So what's tax inefficiency? So if you're to be, if you get lucky in the stock market, and let's say you buy a share for $30 a share, and then it appreciates to 40, and then you sell it at 40, then you would be liable to pay, capital gains tax. Depending on your tax bracket, depending on your capital gains tax, can be anywhere from, from 0 to 15 to 20%. However, if you join a mutual fund, so basically your money is being pooled with everyone else's money, and you just happen to be the lucky one to hop into the mutual fund right when they made this $10, right when they're selling the share for $40 when they originally bought it for $30, although you didn't see any growth in your investment, you're going to be absorbing that tax burden together with everyone else. So that kind of sucks because you're paying their taxes and you're not getting the gains. That's kind of lousy with mutual funds. And then there's a lot of other sneaky ways. I'm not sure exactly how it works, but there's a lot of different sneaky ways how they can, make money. So he gives you an example. Let's say you were to invest $100,000, and let's say you're hoping to get 8%, APY, from growth of your assets per year. So theoretically, you are thinking of getting a whopping $8,000 from your $100,000 in a year. That's not the case, because there's the disclosed costs, there's the hidden costs, there's the tax inefficiency that you have to pay for someone else's gain. Come on, and then there's all the sneaky stuff. So eventually, that all adds up, and you only end up making 1.78% after all the fees. So you're only going to make $1,780 as opposed to $8,000. So those fees really eat up on your, on your return. So that's why, he mentions, a lot of investors mention, that, ETFs is the way to go. ETFs started in 1993, and there are over 2,000 ETFs right now in the market. There's, dozens that came out this year alone. And ETFs are basically like you're buying one stock, and that stock is a conglomeration of, select other stocks. It could be like hundreds of stocks or 50 stocks. Sometimes you could buy ETFs from the S&P 500. You can buy, from, the utility sector. You can bet on the entire world market. You can buy for example, a Vanguard ETF, which is a conglomeration of the entire foreign world. You can buy an ETF that represents the foreign world and the U.S. market. So you're buying one stock, and that stock is so diversified that kind of saves you from losing and protects you from and overall they do pretty well. So some of the benefits that we see in Investopedia, they're cheaper again. So when you're buying an ETF, you're buying a lot of different, stocks. You're buying like a whole portfolio of stock with one stock. However, there are people that managers that are buying and selling. They're trying to balance out the portfolio. It's not like you're buying a whole portfolio and everyone's just sleeping. People are actively trying to make sure your portfolio is going to perform well. So they're there are also fees. You can get away without paying any of the fees, but the fees are substantially less. For example, and before we get to the fees, so let's look at this. So the pricing is cheaper. You have much more flexibility. You could buy and sell whenever you want. It's not as locked in like a mutual fund. They're trying. You could look at the portfolio. You could see what's going on. You could see what the main 10 holdings are. That big tax efficiency. So you're not going to pay for someone else's capital gains. You're going to pay for your own capital gains. But if you have to already pay taxes, let it be your own. Okay. And bear in mind, if you have, like, say, a Roth IRA, you wouldn't even have to pay those taxes if you had a Roth IRA, ETF through a Roth IRA. So let's look at an example of the fees. So let's look at this ETF. It's called VIG. That's the ticker number. I just picked it because I like dividends and the Vanguard Dividends Appreciation. And basically, when it comes to purchasing ETFs, look over here. Always look at the expense ratio. And you see it says 0.08%. That's the fee that I believe you pay it every year for people to manage your ETF for you. So that's less than 1/10% per year. That's way less than the percentages that we've seen in the mutual funds. And then bear in mind that this portfolio gives you a roughly 2% yield. Now the ETF went up after market hours, so maybe it's like 1.96% yield or so. But it's about 2%, and I like that because at least it keeps up. Whatever happens, it keeps up with inflation, and also the dividends from this ETF at least sort of kind of covers the expense ratio. But then overall, it's growing, and this is actually not one of the best performing ETFs out there. But look, this is the 1 day, the 5 day, the 1 month. You see how it's steadily growing. And there are other ones that performed way better than this one. But, over 5 years, let's see, over maximum amount of time. So it's been around since 2006. So we see that recession right there. So it did go down, but it bounced right back up. So it did, it wasn't, it did go down during a recession. But you see how it came back. So if this is a long-term holding, you don't have to worry about a recession because, when the markets adjust, it'll bounce back. And it bounced back pretty nice. It went down from 33. It tripled since the recession. So that's what I like about it. So that's the same thing. So for example, one of the places people like to buy their ETFs is the Vanguard. So the Vanguard is a company that they themselves provide ETFs, and they also offer mutual funds as well. And because they're providing the ETFs, you don't have to pay a purchase fee, a transaction fee to get them. So they actually have a tool where you could compare. So I put down ETFs, and you could buy ETFs either from Vanguard or you could buy them directly from any E-Trade, TD Ameritrade, or Robinhood, whatever you want. You could buy ETFs. I'm not sure if Robinhood has options for IRAs or not. I have to double check about that. But so if you buy this ETF from Robinhood, you're going to pay 0 transaction fee, and you can see right here the expense that we just looked up is 0.08%. That's it. So I just put 6.95 because of TD Ameritrade, but it could be 0 for the trade. And then they compare it to their equivalent mutual fund of this type of thing. And to get into it, you have to put down at least $3,000 minimum, and that's going to be a higher ratio. Your expense will be 0.17. So almost, at least double, a little more than double the amount of expenses. Ouch. They have something called Dividend Appreciation Admiral. Keyword here, Admiral shares, and you have to start off with a bigger portfolio, which I don't have. So if you do the Admiral, then you get the fee of 0.08%. There, it went away. Anyway, so that's that. Now the next question is, how do you find a good ETF? So I found this website. It's called etfdb.com, and they have great filters, and they can. So let's say if you reset the filters, and they're screening all ETFs. So you see over here this 2015 ETF. There's so many ETFs out there. So you can pick from alternatives, the bonds, commodity, whatever you feel comfortable investing in, or you could just leave it blank. And you could do active versus passive investment. You could screen like that. You could do leverage or not. So what I like to do is so I like to have the expense ratio pretty low. So I want to have 0.01 to 0.20. I wouldn't go more than that because that kind of eats away at my profits. And then I want to have something cheap because I want to buy a bunch of them. So let's go maximum $100 per ETF. And then dividend yield, I want to have an ETF that has actually some dividends. So I want to have, I'm not looking at anything less than 2%. So 2% to like, I wouldn't go super high dividends because I would be questioning how how they're going to make money, so they can actually go out of business. I need them to be in business, and a lot of times when you have the higher dividends yield, they're not as stable, they're more risky. So I try to go about 10% max. This is important. You want to make sure that at least they have a 8 to 10% year performance. So roughly whatever, 3 years you want to see like 20%. You want to see at least 20% in 3 years, and then 5 years you want to see like at least 30%. That's what I like to do. I mean, after holding it for 5 years, I want to make sure I'm getting at least 30% of my money. A lot of them go even better than that. So I'm just screening them down, and then some people like to look at volatility. I like to look at volume because that's a sign that if you want to buy, how easy it is to buy and sell it. So I want to see at least, let's see, a nice amount of volume. So if you want to get out of it, you can get out of it. And then, that gives me a 0. 0 ETFs. I have to adjust things a little bit. Let's see how many I have now. There we go. We got a few. So if you want to do price from cheapest, so these all meet the criteria. So you have the Vanguard, the VEA, that's the ticker number, and the price to purchase it is $43.94, and their year to date is 22. So if you bought this ETF, you invested in this. This year has been a pretty good year. So it's been kind of like it's been a bullish year. So. But overall, you could see that you would have made 22.62%. This is the utility sector, and that's 15.77%. iShares. This is international stocks. So let's take a look at this. So let's look at VEA. So this is the developed markets ETF. So you could see their expense ratio is actually cheaper to operate. It's only 0.07 versus 0.08%. Again, you see that the year to date they've done pretty well. Their dividends is actually even better, 2.56. So maybe this would be even a better stock. And let's look at Max. So you see they're kind of up and down, So let's look at the other one that we saw, the XLU. Utility sector. So to buy into this stock, it's $54.70. They're a little bit more expensive to operate. Their yield is pretty good. Year to date is 11.78%. And they've been, they had their ups and downs, but overall, it looks like they're growing, And then finally, let's look at the IEFA. It's the emerging markets. It's everything besides the U.S. and Canada. It's like the Middle East, Australia, IEFA. iShares Core. So for this market right now, to get in is 67 $64.70. Their expense ratio is good. It's like less than, I like it, less than 0.1% is good for me. The yield is, everything is doing better than the high yield one, their dividend yield. And the year to date is pretty good too, 21.55%. And then going max, it went up pretty well, and then, they made it way back up again. So that's pretty much it. So yeah, I hope you guys enjoyed. Give me a thumbs up or subscribe, if you like my channel. Thank you.